Hello, I'm Aditya and welcome to Earthward. The idea here is simple. Each episode, I take developments from the world of fintech and financial services that actually matter and break it down. Not just what happened, but why it happened, what it signals, and what it opens up for the people building. There's no shortage of noise in this space, but most of it is just reporting. Earthward is meant to be the opposite. Fewer stories, more thinking, one shift at a time looked at properly from the perspective of someone who's watching this ecosystem up close. So let's get into it. And today I want to talk about where startup money actually went last month. Globally, fintech raised about $12 billion in the first quarter, and on its own, that looks fine, even healthy, until you notice it came from roughly a third fewer deals than the year before. Same pool of capital, far fewer companies. The checks are getting bigger and they're going later stage, and most of them are landing in infrastructure, stablecoin rails, AI tooling, the parts of finance that sit underneath everything else. And India didn't move the same way. In a single week of June, Indian startups raised close to $470 million, but it was scattered across 19 companies and more than 10 sectors. Nothing really crowding into one theme. And alongside that, the exit doors are also starting to open again. Totalment priced its IPO, Geo Platforms filed its DRHP, and a few others are clearly lining up to move. Globally, this is a fairly familiar late cycle behavior. When the market turns cautious, capital stops spreading itself thin across consumer bets and consolidates into the infrastructure layer, the picks and shovels everyone has to buy regardless of which company ends up winning. India looks like it's resisting that with all its breadth. But I don't think it's really an exception. I think it's just earlier in the same cycle. And the reopening IPO window is the part I'd watch most closely because once exits start working again, money tends to concentrate behind the companies that can actually reach them. So if you're raising right now, the quieter shift to register is in what actually gets you funded. The market is asking harder questions than it was a year ago about real unit economics, about the route to profitability, and about whether there's a believable path to listing somewhere down the line. A growth chart on its own doesn't carry around the way it used to. None of that shows up in the headline funding totals, which still looks perfectly healthy. But it's sitting right underneath them. Better to build around it now than to run into it at your next race. That's how I'm watching this. I'm Aditya and this is Ratwa.